When considering an investment, there are a few questions that are as important as what is your time horizon? The answer can guide your decisions on what kind of investment vehicle to consider, which investments to avoid, and how long to hold your investment before selling it. Hello everyone, welcome to Finance Professor channel. Today, we will talk about another interesting topic, how to invest for retirement in the next 5 to 10 years. What kinds of investments should you make over a 10-year period so that you can benefit from them in retirement? It's important to remember that most people under the age of 30 typically aren't thinking about retirement, but by the time you reach 55 or something, you most likely are. Anyway, today's topic is all about what to invest in if you have a 5 to 10 year time horizon, which is an intermediate term. At this range, some exposure to stocks and bonds will help increase the value of the initial investment, and the time until the money must be spent is far enough in the future to allow for some volatility. Stocks and bonds are mixed together in balanced mutual funds, which are common investments for midterm objectives. To help us avoid the negative consequences connected with poor timing, financial services companies have developed a range of investments including: Number 1. Target date funds. A target fund is a class of mutual funds or EFTs that automatically rebalance their portfolio's mix of assets, stocks, bonds, and cash in accordance with a chosen time period. Target date mutual funds are frequently chosen by investors setting aside money for retirement, but they are also used by those saving for other large expenses in the future, like paying for a child's college education. These funds usually mature in 5-year intervals and are typically designed to gradually shift to a more conservative profile as the target date approaches to reduce risk. Target date funds are frequently available through 401k plans. Some of these funds serve as a default investments for participants in 401k plans who haven't chosen their investments yet. You should carefully consider whether a target date fund is right for you both before and after investing. Number 2. Mutual funds. A mutual fund is an investment vehicle that pools money from investors and invests the money in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are a popular choice among investors because they typically offer features like professional investment management, where your research is done for you by the fund managers, diversification, or the don't put all your eggs in one basket, as this reduces the risk of you losing money if one company fails. Affordability, as the majority of mutual funds have relatively low dollar threshold, and liquidity, which means investors can conveniently redeem their shares at any time for the current net asset value, or NAV, plus any redemption costs. Number 3. Stocks and bonds. If you have the time, skill, and interest, you can create and manage your own portfolio using stocks and bonds. You can change your asset allocation over time to favor less risky investments. Investors looking for income can benefit from either stocks or bonds since both offer fixed dividends and regular interest payments. But it's crucial to understand the similarities and differences between these two classes of securities. Bond funds typically aim to produce higher returns, so they carry higher risks than money market funds. The risks and rewards of bonds funds can vary greatly due to the wide variety of bonds. Compared to bonds, stocks have a chance to produce higher long-term returns, but they carry greater risks. Stock funds invest in corporate stocks. There are variations among stock funds. Some examples are growth funds that concentrate on stocks with the potential for greater financial gains than average but may not pay a regular dividend. Income funds invest in stocks that regularly pay dividends. The Standard & Poor's 500 S&P 500 Index is one example of a market index that is followed by index funds. Sector funds focus on a specific industry subsegment. By holding a mix of different investments, you are diversifying your portfolio. Number 4. Real estate. If you're approaching retirement but lack the necessary funds, think about investing in real estate. Because the rental real estate market is so inefficient, it is possible to find fantastic deals with extremely high returns on investment. This makes rental real estate a good source of retirement income. It is important to consider though, if you need to borrow to buy a rental property, you'll need to act before retiring. Applicants for mortgage loans must typically be employed and have at least 2 years of continuous employment history in the same occupation. If the buyer won't be residing in the property, Lenders also demand a sizable down payment, typically 30% or more. Net of all costs, you should make at least 8% on the capital you invested in the rental. The 8% is justified on the grounds that it makes up for your investment's risk and relative illiquidity. Always keep in mind though that choosing a good location is more important than the cheapest property. So, consider looking for a location with low property taxes, a good school district, and a variety of amenities such as restaurants, coffee shops, shopping, trails, and parks when choosing a profitable rental property. Number 5. Roth IRA. A Roth IRA is an individual retirement account or IRA that offers tax-free growth and tax-free withdrawals in retirement. Investing in a Roth IRA is pretty straightforward once you've satisfied the income requirements to make contributions to the account. A Roth IRA might offer you the best of both worlds in terms of early retirement savings for at least some of your money. The main advantage of this is that, provided the account has been open for at least 5 years, your contributions as well as the earnings on those contributions can grow tax-free and be withdrawn tax-free after the age of 59 and a half. To put it another way, you pay taxes on the funds you deposit into your Roth IRA, and all withdrawals made after that are tax-free. A Roth IRA can be opened through an online brokerage account, a robo-advisor, a bank, or a credit union. If you choose an online broker, money can be used to buy stocks, bonds, mutual funds, and exchange-traded funds or ETFs. You can deposit Roth contributions in a savings account or a certificate of deposit or CD at a bank or credit union if you make that decision. You can invest in alternative assets like cryptocurrencies, gold, and real estate with a self-directed IRA. Thank you guys for watching this episode. We hope you found it interesting and helpful. Please like and share this video and subscribe to our channel, The Finance Professor. Also, click the bell notification button to receive updates on our videos. Bye for now!